Good afternoon, everybody. Today is Friday, November 17th. This is your weekly take on the market. It is 1:30 Pacific time. Market has been closed for about a half hour now. My name is Scott St. Clair. I am your host. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD that I'm aware of is licensed. We can't tell you what to buy, what to sell, how much to buy. Uh, our circle of competence is education, research. Okay, thank you for that. Market thoughts. I don't have any slides today. I didn't grab anything from Twitter or wherever or Substacks, etc., like I normally would. Uh, I think it was all the same stuff. The market's narrow. The S&P, the Mag 7 are up 1,000,000%, and the S&P 493 are up 1%. It's the same story. So I didn't see any value add there. So we'll go through the indexes. We'll look at the industry groups, and then stocks to watch, which I just think is the most important part. If is there stuff to buy? Is it tail wagging the dog or the dog wagging the tail? I don't know. I don't know which it is, but I think you're much better off. At least I feel that way. Just looking at leadership. Are there stocks to buy? The stocks that you own, stocks that you wish you owned. I just think there's such a great story if you're willing to be flexible and open-minded to what they are telling you. So that being said, let's pull up the indexes. And you should see a chart of the NASDAQ. And make sure I'm reset to today because, yeah, so that doesn't look right. Thought we were much closer to new highs than before. So you've had this really powerful rally off the bottom. And I'm going to show you just so we can, look for like an analog. We'll look at a bull scenario and a bear scenario just to play both. I know that Charles Harris was on the IBD podcast this week, yesterday or Wednesday. And sorry about that. And he talked about, he's looking for a precedent. I know he likes to do that. I don't do that much, but it's kind of fun, I guess, in certain situations to look for a precedent. Like, in other words, what does this market look like historically? How did that market play out? How did it end up? So a really powerful move off the bottom here. And it just looks to me like it's going to make a new high. I think last week I thought the QQQs would make a new high. I still think that they missed by 23 cents on that day. The SMH did make a new high with the semiconductor index. And so you have that. So I think you're going to get the SMH make a new high, the NASDAQ make a new high. And, the other side of that coin is you're going to have a big divergence. Where a couple of areas are new high and the S&P and the Russell and the Dow are not. So it should be, that's, interesting how that plays out, that divergence. How will that end up? But as we sit here now, I think it's easier. My favorite way to evaluate the market is like the weather. So if it's raining, and you ask me what the weather is going to be like in an hour, I think I have a pretty good high probability of what it's going to look like in an hour. You ask me what it's going to look like in a day, I can probably guess pretty, not as good an accuracy, but pretty good. A week, a month, a year, 5 years, 10 years, you get the idea. The further you go out in the food chain, the less probability you have of being correct. And that's the same with the index, which is why Bill would say, just observe what the market is doing every day. Bill would say, I come into the market, I come in, I sit down at my desk, and I just see what the market's going to do. I don't have any idea what it's going to do. Or the goldfish analogy from the book, How to Make Money in Stocks. where the Harvard professor asked his students to write a paper on goldfish. And he just really wanted them to observe what goldfish do. So each day I just observe what the market is doing. And if you're open-minded, it's, this is not a market that wants to go down. And we made a huge move off the lows, and it's not giving back hardly an inch. So as we sit here now, it's fairly to moderately to wildly bullish. It just depends on how open-minded you are to that. That could change, but as we sit here now, it's pretty strong action, and so you probably should have some exposure, at least a little bit. I would say if you don't have any exposure, you're doing it wrong. It doesn't mean you have to be 100%. That's one of the advantages you have of being, if you're running your own money, of being an individual investor or retail investor, whatever you want to call it, is you can be 60% investor, you can be 80% invested. And with the types of stocks that we can pick and the tools that we have to identify leadership, you don't have to be 100% to participate with the market. You can be 60% and do better than the market, I find. So market looks fine right here as we sit here, especially on the NASDAQ side. The S&P, again, 1, 2, 3, 4, 5 days in a row. It's just kind of digesting the gains so far. So pretty bullish. Russell, it's the dog with fleas. It just doesn't look all that great to me. I mean, look at the bars. The Russell is just strange. Look at how big the bars are. It just trades all over the place. So I don't really watch the Russell. If it weren't for this video, I don't even know if I'd pull it up. I just don't find a lot of value add in the Russell, but there it is. Just a lot of noise in the Russell. And then the Dow Jones, I guess we can pull up the diamond. I don't watch, I probably watch the Dow slightly more than I do the Russell, but I think the S&P and the NASDAQ are more than enough. So the indexes as we sit here are fine. So from a precedent standpoint, what had me thinking this market, I don't know if you ever heard this term that some people use called a lockout rally. It's where the market goes up and then never pulls back, and you just feel like you're on the outside looking in, and it just gradually each day pulls people in. I think Jim Ropel mentioned that on IBD Live today. And I do remember that fairly vividly in this time period. So this is the Asian crisis, the Russian ruble devaluation, the long-term capital meltdown, and see you had a huge day there, and then just pretty much day after day after day. I think this might be a bad tick. I don't remember that happening. I think that's a bad tick, but just kind of relentless up. And I remember being kind of on the outside looking in. I felt like we were in a bear market, and it just kind of didn't seem real to me. It went up so fast. And I think it was like somewhere in there where I finally realized that, I don't think this market's coming back, Scott. I got to start participating. I don't remember exactly how it played out, but I do remember being a little gun shy down here when it first started going. I wasn't participating in the rally. And if I fast forward this a little bit here, look at that. Just incredible how what you thought you missed was just the beginning of a tremendous ride. So I can't say that that's not a possibility. I don't think it's likely, but there's not a zero chance. So maybe we're in the start of a new bull market. The average stock, most stocks have been in a bear market for a long time. So you could play devil's advocate and say we've had a pretty long bear market, and the indexes did a good job of masking that. But, Shopify's of the world and Twilios and Teslas, they all went down a lot. And so maybe this is just the continuation of another up leg, and that would be tremendous if it did that. So I guess you can see how if you're sitting here waiting for it to pull back, you can get that's what they call locked out. You just don't get involved. So you got to get involved, which is why we have that rule for the follow through day. You buy something. I know that not everybody loves the follow through day signal. It's not perfect. I agree. It's got flaws, but you're erring on the side of giving the benefit of the market the benefit of the doubt by buying something if you're not invested, and then you get feedback. So that's something you should do, especially if you're all in cash. If you have some positions already, maybe you don't need to add something else. But I always like to add something and say, okay, how is XYZ doing when you buy on the follow through day? If we were to go to like 2001, maybe that might be too far back. Yeah. When was it? I think I wrote it down, 717. So you get this pretty big rally off the lows, and you'd be surprised that this is like a 40% move. If I did the math right, 40%. It looks like nothing, right? But 40% off the lows, and people would be running around telling you you're in a new bull market. The market's up 40% off the lows, and you wave down, another wave up, and then capitulation. So that would be kind of the really bear case. And in the end, I think you don't know. You just play it day by day. And when I look at this, this is bullish, really bullish action. You get kind of one bad day, then you get a really bad day, right? You probably would be reducing your portfolio. And then the market kind of fools you, comes back, and you say, oh, boy, I'm sorry I did that. But then has another really bad day. So you're reducing your portfolio. And then probably tries to come back. Nope, has another really bad day. So maybe you're reducing your portfolio. And that's kind of how you do everything. Incrementally in, incrementally out, at least over a number of days to weeks. So I guess I don't have an answer for what the market's doing. There are a lot of stocks that I like that are acting well, some that I own and some that I wished I owned. And I don't have a handful of short ideas, but no desire to be short just yet. So that's how I'm playing it as of now. And some of my ideas are not, like the uranium trade. It's like it's kind of on its own. It's kind of in its own universe. It's unlikely to be that affected by what the Nasdaq does, unless something really bad were to happen. I think if you had a really bad bear market, all stocks go down. People want liquidity; they just want out. All right, so that's the indexes. There are overseas. This looks really good. The ePolin ETF, I own that. HEDJ, is that the one? I keep messing that up. That's the Europe one. HEWJ is the Japan one, which I own, and that one's, it's not setting the world on fire, but that looks very good as well. I think there was another one that was interesting to me that I don't own. Can't recall what that international, but so maybe the market's getting a little bit broader. I don't have a lot of desire like for Chinese stocks. BABA, no thank you. PDD is probably the best of the worst. It's actually holding up really, really well. Li Auto is interesting to me. This, big earnings and sales, this is very appealing to me, but it's tough stock to own because it gaps up $1 or $2 almost every day, because it's trading overseas in China. So, but this one is interesting to me. So if I had to or wanted more exposure, these would be the ones. So that's where we are in the market. Let's go to the industry groups. And industry group current. Energy coal, I do have, I have one stock there. I did have two, now I have one. It's the number one group. I guess we'd need a whole TED talk on why, but it is what it is. So I like exposure there. Food, dairy products, not that interested in. Two stocks. Contract manufacturing, which haven't had a stock in there in a while, but that's been a pretty good group. But like I talked about last week, these are all growthy groups: software database, software desktop, education, computer software education, hardware peripheral, apparel, shoes, maybe not so growthy, but good enough, Deckers and stuff like that. Computer software financial, maybe Intuit, I think just broke out. Oil and gas transport. I've always liked that group. I think that there's great names there. So there's a lot of potential merchandise. I know the market is thin, it's narrow comparatively, but if you want to own 10, 12, 15, 20 stocks, they're out there. And it's kind of broad. There's stuff you can own. You can own a uranium stock, you own an oil and gas stock, you own a shoe stock, Deckers, you can own a couple of semiconductors, NVIDIA and Avongo, AVGO, software, Microsoft software, ServiceNow. I could go on and on. So it's actually probably not pretty broad for us. And stock picking, which is fine, is the market has gotten larger and larger, and stock picking is probably just going to become more and more important, because the Apples and the Teslas and the Nvidias of the world they're just not going to go away. Microsoft, they're so large, so entrenched, they're just going to make up a large portion of those indexes for a long time, and you're just going to be kind of stuck. It's possible that the indexes do nothing for a long, long time, give or take a 15-20% range. I would think the Apple is probably just, it's not beyond that this is the high for years and years and just goes sideways for a long time. Who knows? All right. So other stocks, let's start with the coal stock, AMR. This is my coal stock. It's acting really, really well. I love this type of action. So it shakes out, closes on the low, looks like it's going lower, gaps up the next day. Why? I don't know. Maybe it was earnings. Was that earnings? No, the earnings were a few days before. It just did that and then kind of traps everybody. So this looks very powerful to me. I got out of CEIX, not that it did anything wrong, because I bought it somewhere in here, but it's coal. I don't know if I wanted to. In fact, I didn't want to own two coal stocks for whatever that's worth. So I just figured there was a day, I think it was yesterday, and today's a good tell. So yesterday, CEIX was down. I can't get my mouse to hover over that. Oh no, the track price is messed up. I think I need to fix that. But CEIX was down yesterday, and AMR, although it closed on lows, was up. And that was kind of a tell to me that maybe AMR was better. Today, AMR was up 6%. CEIX was up 3%. So another tell. Now, I know it's only 2 days, but those are the two tells. There was a coal stock that broke out today. Was it HCC? Yeah, Warrior Met Coal broke out of a small consolidation today as well. So there's the number one group. As far as software, you've got ServiceNow, which should have been bought somewhere here on the fall today, or somewhere here. If you bought it, you'd be up 7% or more. Doing nothing wrong, you leave it. Microsoft, doing nothing wrong. It's big. It's going to be a little tougher, but you leave it. Jim Ropel talked about MDB today on IBD Live. Looks very interesting to me. This looks a little bit double bottomish to me. I would think you probably could buy it off of that as a pivot. You have earnings in a few weeks, but look at the big earnings and sales. Really big numbers. Look at the margins, 75, 73. So this is an interesting potential idea in that software space. Melly broke out, cup with handle, holding up. Ross Stores. See what I mean? You're just across the universe of different types of groups. Ross Stores, brand new high, Urban broke out. Not doing a whole lot just yet. I don't own any of these. Abercrombie and Fitch has just been a beast. This looks, it might be a little soon, but that looks a little offensive sell signal-ish to me. If I own that, I'd probably be a seller, but I don't own it, unfortunately. But that looks like consolidation is around the corner. What else? So Pulte Homes, you can own a home builder. Pulte Homes breaking out of a base, or Toll, I think, breaking out. Gosh, it's just incredible the list. Of course, Nvidia broke out of its double bottom, and you have earnings next week. Not to reference Jim Ropel again, but I will a third time. He said something that we probably all already know. This is the most important stock in the universe. How it reacts to the earnings will be a very, very important tell. It's not going to be what the earnings are going to be. I imagine the earnings are going to be tremendous, but how the stock acts. I think in a perfect world, it does nothing. That would be ideal. So nothing meaning up or down $5 or $10. And that would tell me if they come out with a big, really good earnings report and the stock just sits there and does nothing, there's going to be, you're not going to get any of that buy the rumor, sell the news. Might take a handful of weeks, but that would allow the stock to leg higher. SMCI is kind of in that same vein, double bottom. Not a great base, admittedly, but if the AI if we're in the third inning of the AI, then this stock's probably going higher. It's they build the systems that people need for that. I saw a really good video where they explained kind of this company by there's a group of 3 guys, they call themselves Dumb Money, and they do YouTube videos, and Chris Camillo, Camillo, I think is his name. He was one of the unknown market wizards. He's part of that group, but they talked about this stock, so I watched that video just to kind of get a little bit of feedback from this one, because I never did anything with SMC. I never did anything. I just had a hard time. Like the earnings and sales aren't all that great. So it doesn't trade really good. It's a pretty sloppy trader. So I've just avoided it for a while. And I just thought maybe I had to understand the story a little bit more. So it's on my radar. It's a possible one. Like you can see the trend line I have drawn right there, like as a little mini pivot. I think, oh, I know. And then, then how about the biotech area? So you have NVO, which I think is acting just fine. It might not be going up as fast as I want it to, but sure is acting really well. Lilly's a little different, but at least now you have a base. And I think there's a couple of ways to play this. You either own one or both, but you probably want exposure in this area, I think. So I do own NVO and have for a while. It's not a great big position. It's kind of small, but it's because I want to just leave it be and see if I can give it some room. Oh, that reminds me. So then you have like CRISPR today, which I believe got not FDA approval, but in the UK approval. And what I like about this is it's the animal spirits is the term that I like to use. People, institutions, investors are willing to go out on the risk curve, and yeah, for lack of a better word, speculate, which is good for the market. So it tells you it's a very powerful signal from the market when they're buying stocks like this versus just buying Walmart and Apple and Target and Google, etc. So that's very interesting. This is probably one of the ARK. Did ARK do? Yeah, ARK had a pretty good day today. This is very interesting to me because it owns all that really speculative stuff pretty much. So I watched this. It's building this giant cup with handle. Wow, it's just crazy. The hugest, biggest cup with handle in history. 45% deep, 34% handle. The handle's like 35 weeks long. It's it's obviously not a great pattern, but I would watch this because if this gets legs, if this one can go up, it's the animal spirits. They're willing to go out on the risk curve if they're buying this one. Uh, what else? Last but not least, uranium URNM broke out. Um, I'm drinking the Kool-Aid in this group. I have a massive position across the spectrum on uranium, whether it's junior miners, URNM, or the Sprott physical stuff, which is not in Mark Smith because it trades in Canada. So that's the stocks. And there's a lot of stuff. And there's plenty more that I didn't get to. In fact, we were just talking about the near pivot, 42 stocks. The recent breakouts, 91 stocks. I can't document, I can't say I know for a fact, but I think you'd be hard pressed to find ever that number has been that big. That's probably a record. 91 recent breakouts. Remember, they stay in there for 3 weeks, 15 trading days. So 91 breakouts. There's a lot of stuff in there. And on a side note, I know we had a little bit of a bug on the breaking out today. So like, I can't remember like what stock broke out yesterday, and then you get the breaking out alert email the next day. I'm trying to fast track that bug to get fixed. We're kind of in the holiday thing where, every week there's people on holiday. And so we don't have as many programmers as we had, but to me, it's a high priority bug. And so I'm trying to get that resolved for sure. Thank you for your patience on that. Okay. All right. Let's go to the quote of the week. Sure, I'm sharing my screen. Stanley Druckenmiller. I'm going to use him again. I think last week I used Paul Tudor Jones from the talk, the Robinhood talk that he did, and I don't know if this came from the same talk with Stanley Druckenmiller, but it's a great quote. Diversification is the most destructive, overrated concept in our business. Pretty powerful statement. Destructive is gosh, that's pretty powerful. Overrated, I get it. Bill would say diversification is a hedge for ignorance. I once told my finance professor that in business school. I was 29, 30 years old and thought I knew it all, and thought I would, when she mentioned diversification, money was falling out of the sky in 2000 when I was in business school. And I told her that I shouted out that diversification was a hedge for ignorance. Of course, she called me on it, asked me to explain, and luckily I knew just enough to not embarrass myself. But I found that very interesting that we had the thought process of her as a finance professor and me as a 28-year-old snot-nosed kid who read a book called How to Make Money in Stocks and was making tons of money. And to me, the proof was in the pudding, because it was working. So diversification is the most destructive, overrated concept. Look at George Soros, Carl Icahn, Warren Buffett. What do they have in common? They make concentrated investments. The way to do well in the market is, there's two ways, really. I mean, cutting losses is important and riding winners is important, but you have to have some size when you get something right. If you don't have any size, then all you have is a great story. If you have 100 shares of Facebook or Meta that you bought on the IPO, you've got a great story. You haven't made it move the needle on your portfolio. If you've got, a couple $1 million portfolio, that's fine. You got to have some size. So I'm big on size. Like I really, it's one thing I do pretty well, concentration. But also, when you concentrate, you have to be willing to cut pretty quick, which is why I probably cut them a little bit too soon, because when you have size and they start moving around, you start to see zeros rather than percentages. So, but and it's something for everyone as far as what is considered concentrated. I don't think you need to own any more than 20 stocks. I think 20 stocks is more than enough diversification. I rarely own more than 8 or 9. If I was fully invested, like it would 8 or 9 or 10 maybe. If a couple of times I've gone further out on the curve, it just felt uncomfortable. I just felt like I couldn't watch the names. I couldn't get to know how they traded. It's hard for me to know something wasn't right. And sometimes I've had some smaller positions, and they'll go down, and I'll say, oh, it's just a small position, and then it goes down a little bit more, and it's like, oh, it's a small position, and then it goes down a little bit more, and pretty soon it's like, oh boy, how did I get down that much on that position? Because I didn't respect the risk as much as if I had a real position. So find out what that number is, excuse me, for you. You really should kind of know. And Bill was sometimes felt comfortable having his whole account on margin in a single name. I don't do that anymore. I might have done that when I was 28, 29, 30 years old, but I don't do that at 50 some. I just don't think it's worth the risk. And even for Bill, as he got older, Justin would often say his risk tolerance contracted for sure. So a lot of this will depend on where you are in life, your lot in life. If you're younger, I think you have a lot of runway. That you should be more concentrated, take more shots. It might work. All right. Okay, everyone. So today is Friday. Next week is Thanksgiving week. There will not be a take on the market unless something drastic happens. So it's highly unlikely. I'll be out of town, so I'd be doing it from out of town. But if something really drastic happened, I felt like there was a message, I'll do one, but it's unlikely. So have a great holiday, everyone, and we will see you in a couple of weeks. Marcus Smith at investors.com, 800-424-9033. Thank you.